Hi, it's Chrissy. I'm sitting here with Rich with the Supreme team, and we are here to talk mortgage items. So, Rich, I actually realized I've never asked you, how long have you been in the industry?
Just under 15 years.
15 years, so 2004.
Even though I look so young.
So young. But, so 2004, so you were around for the last recession.
Yeah.
Okay, what's your take?
There's a laundry list of things that I would mention about the recession. Obviously, everybody talks about bad lending practices. Obviously, it was an unregulated industry. As a matter of fact, I remember when they went to licensing, a lot of people were groveling about it and upset about it, and I was actually excited about it. I was wanting to get a bunch of the jokesters out of the industry. But my thing about the bad lending practices were, again, unregulated. The idea that values were always going to go up, so a lot of the lenders were not concerned about the loan products they were providing. Stated income type stuff. They were giving them option loans. When a consumer looks at 4 options and they say, okay, where it's a reverse mortgage option, there's an interest only option, there's a 30-year fix and a 15-year, they're going to look at those payments and they're going to be like, I don't want any of those, I want this lowest payment. And then all that did is add balance to the loan and then the value, obviously. And then when everything came crashing down and they had higher rated MBS, or basically these mortgage-backed securities, and they started defaulting because people couldn't afford their actual payments because they were saying they made X amount of dollars they didn't really make. Then they started losing their homes. It just came crashing down, you know what I mean? And then it started creating, wow, we need to start regulating this stuff. These people are doing whatever they want to do to get mortgages. So that's really what caused the recession, and a lot of people are concerned about a possible recession that's happening soon. The regulation that's happening now and the restrictions they have to mortgages, I don't see that happening again. You have to, it used to be back in the mirror, we joke about it now, breathe on a mirror, get a mortgage. It's not like that anymore. You obviously have to go through a lot more digging and prying into people. Some things I don't agree with, but they overly check things now, make sure you can afford things. So the default rate is going to be drastically reduced because of that, causing the lack of a possible recession, at least in the mortgage industry. There might be some issues with the stock market and things like that that might happen at some point. Depends on what happens in the trade wars and everything else, but I don't anticipate there being a housing recession, mainly because of that. You're seeing the economy doing well, so people are making more money, values are going up, interest rates are down, so people can afford more homes, so there's just opportunity because of that. But an actual crash like we had in 2008 is just not going to happen right now.
And I've heard a lot about that, how recession and housing market crash are 2 different things.
Oh yeah, absolutely.
And so just separating those 2 and hearing from you guys that, hey, the industry is doing well.
Yeah, it is. I mean, you just have so much regulation and so much protection in that sense. Are there going to be defaults? Absolutely. There's a lot of these down payment assistance programs. People get in homes with very little money out of pocket. They're not as concerned about the money that they've invested because there is no money invested. So you're having defaults in that sense. But a lot of the down payment assistance programs are also making some adjustments to it, not loosening things up. They're actually making it harder or tighter or more difficult to get those programs, or putting restrictions on them, not allowing them to go to crazy debt-to-income ratios and things of that nature. But so, my opinion, a recession, housing recession,
not going to happen. Okay. In fact, I'm actually kind of seeing more people buy, and then something happened last week, on Wednesday.
Oh yeah.
The feds. What happened?
So ever since, not to talk about political stuff, but ever since Trump took office, the Fed actually has been raising the rate over and over and over and over again. And there's been kind of a battle politically with the Fed, kind of pressuring them to reduce things and cut rates. I don't think they're as low as they were before, but they're starting to cut rates. Now, what people need to understand is they're not cutting mortgage interest rates. They're cutting short-term rates, which is basically money being traded behind or between banks. Okay. It'll have more of a direct impact on HELOCs, credit cards, auto loans, things like that. There is not a direct correlation to mortgage rates, but it does have an eventual impact because investors will start shifting their money, doing things that will start to impact mortgage-backed securities and interest rates in that fashion. So it takes a little bit of time for it to have an impact. It could actually happen overnight, but
So can you break that down? Like Fed's drop rates on Wednesday.
yeah.
How is the next 12 months going to pan out for this?
There's still some more Fed meetings before the end of the year. So who knows what's going to happen. It's also, there's a lot of trade war stuffs and sanctions that are being put in. I mean, there could be the most weird things happen in foreign markets that could have an impact to us.
Okay.
But I don't anticipate rates rising or dropping drastically. I think they're just going to kind of stay around the same. When they, again, people hear on the news the Fed cut the rate and they think, oh my gosh, yeah, rates are going to go down and it's going to do crazy stuff. I mean, does it have an impact? Yes. Are you going to see a crazy rate adjustment? No, not necessarily, but you might have cost adjustment. So what people, and as a consumer, and I hope as a consumer you're watching this and thinking, oh, you know, because I get this question all the time, you know, as a lender, what is your rate? That's like saying, you know, I don't know. Well, I have no analogy actually, but I guess the point is that there are so many factors that play into an interest rate. So for example, program is one. You could have government finance, an FHA, VA, USDA, conventional. There's so many different options as far as that's concerned. So those all have an impact. Conventional financing is very much based on loan level pricing adjustments. As a matter of fact, if you want to Google that right after you watch this video, loan level pricing adjustments, you can pull up a matrix for Fannie Mae, and it's very heavily based on risk, which has to do with credit score and loan to value. Also loan type, it could be a cash out refinance, is higher risk. Someone with a higher credit score obviously is more credit worthy, so they're going to have less risk, less loan level pricing adjustments. You can, as a 620 credit score borrower versus an 800 credit score borrower, or even 740 plus is really the say-all be-all, you could get the same exact interest rate as each other. However, the 620 person is going to pay more to get that rate. So what is your rate? There is no set rate. We have rate sheets. We have a low rate that you can pay a bunch of money for, or a higher rate that you can get credited for. There's a middle ground. It just depends on your situation, how much money you're putting down, how much equity you have in the home, what your credit score might be, what loan type you're doing. There's so many factors that play into a interest rate that people don't realize that, you know, published rates online, for example, you know, you got to read the fine print. There's someone paying to get that. There are also higher credit score people putting excessive money down. Or
I thought of an analogy, by the way. Maybe it's like walking on the car lot and saying, how much are the cars?
Yeah.
How much are the cars?
How much is your car?
Yes.
What car?
There's all these cars.
Yeah.
Which one are we looking
What
at?
options do you want?
Yeah.
Do you want
So.
a moonroof? Do you want, you know what I mean? There's just, you know, when you see like the published rates of like what the going rate is, there's other factors that play into that. Your situation is always going to be completely different, and so you kind of have to trust the experts to give you that guidance on what to suggest. Hey, if you put a little bit more money down, there's less loan level pricing adjustment to this, you might have a better interest rate. And better interest rate just means the cost of that goes down. So again, I could have the worst of worst credit score, LTV, all that stuff, and get the same rate as someone with all the other good stuff, but I'm just going to pay more for that. So also, when you're looking into lower rates versus higher rates and what to do, your situation is going to be contingent upon what your game plan is long term. Like for example, we were just talking about Chrissy. Can I bring up your personal?
Maybe.
She's thinking about selling her house and buying a new one. Well, she could refinance, but is the recoup time there? You know, is the cost of the refinance from the paper pushing to the title work to the cost of the rate, is that all going to be recouped? And what that means is if I invest $5,000 or $6,000 or $10,000 or whatever it is into either an interest rate or cost of refinance, and it's going to save me $200 a month or $100 a month or whatever the case might be. If you put $5,000 in my hand and I say, okay, savings is $100 a month, well, it's going to take me 50 months to get that money back. That's a recoup time. Eventually, I start paying you $100. So you have to look at it from the perspective of what your situation is, what makes the most sense. Talk to the experts, someone like my team, myself directly. It doesn't matter. Someone's going to give you the right advice if they know what they're doing. So all those
It's
things.
actually a really good point too for those of you, like, even though like we're talking about refinancing, possibly selling, but looking at that, like, it doesn't make sense. Like, if you're going to be selling within the next year or two, you're paying thousands of dollars and getting back $100 every month.
And if you're talking to someone and this is an industry where, you know, I make money doing what I do, right? Unless I'm closing loans, I'm not making money. But I've been doing this so long, I don't look at transactions or doing a refinance for someone or a purchase for someone as money-making activity. Yes, I look at it as I'm making money doing what I'm doing. However, I give advice, correct advice. As a matter of fact, I have a client I've been working with for like 12 years. I've done 3 or 4 transactions for him. He texted me the other day and he goes, "Hey, is now a good time to refinance?" Looking at things and stuff like that. I go, "Nope." And he goes, "This is why I go to you, because I will tell you the truth." Like, if they're just selling you on stuff, I remember this is 10 years ago, and I'll end with this. Okay. I had a manager of mine, and I hope he's watching this crap. The client had a 30-year fixed at like 4.25 or something like that, and rates were not below that. However, he had looked into a 20-year, and the rate was 4.25. It was literally the same rate he had. Well, the loan he was in had no prepayment penalty on it. You can make your own amortization schedule. If you want to pay extra and do a 20-year term, pay extra on it on a monthly basis. You'll pay it down just as fast. You're skewing your own amortization schedule. Well, he's like, sell it. He could pay it off faster. I'm like, are you kidding me? Like, that's not the advice. It's mind-blowing, the people that are in this industry. That's why when I talk about the recession from before and the regulations and people getting licensed and stuff like that, I was hoping all the jokesters would get out. There's still people that are just trying to make money off you. So be smart. Talk to people that know what they're doing. If they're giving you the advice that says don't do it, then you need to hold that person's phone number and talk to them for the rest of your life, because they're telling you the right stuff.
So, thank you so much for all that. You can reach Rich at
480-405-7700, or on Facebook, just go lender. Facebook.com/lender.
And you can find me right here on this channel. So thank you so much for the info. If you want to talk home buying, you can contact me. If you want to get a hold of Rich, talk refi, talk interest rates. Thank you so much.
Deuces.